Welcome to the first episode of Policy Implications podcast, where policy meets research. I'm your host, Olha Zadorozhna from Kozminski University, where I teach and do research in empirical economics. My guest today is Aneta Hryckiewicz, who's also a professor at Kozminski University, an expert on banking and finance, and a leader of Big Data Science program. Today, we will be talking about her recent paper called New Bank Resolution Mechanisms. Is it the end of the bailout era? That she has written with her co-authors Natalia Kryk and Dimitrios Tsomakos. So welcome Aneta, and let's get started. First, tell about your research expertise and how did you become interested in the topic of bank resolution mechanisms?
Actually, the history how I came to the topic is quite long, and it started even before the financial crisis of 2008. So I was the research assistant at the Goethe University, and we had a chance at the time to meet very interesting people from various central banks. And actually, they brought my attention to the bailout topic, which occurred and was widely used actually in the emerging countries in the recent crisis. And this was actually the reason why I started to research, and then the crisis came in 2008 and the topic became very timely and interesting for all of us.
Exactly. So what are those bank resolution mechanisms? What are the bailouts that the financial authority uses, and why would banks need ones?
So actually we have to differentiate between the resolution mechanisms and the bailouts. When we think about the resolutions, we think about the kind of the restructuring measures aimed at recovering, improving banks' financial health. Whereas when we think about the bailouts, then actually this is already when the bankrupt bank needs help from the government. So already the bank is in distress, and no other measures actually can help the institution, only the external financial support. And so this distinction is very important to understand what we are going to talk about.
And what are those bailouts or resolution mechanisms that are available?
There are actually a lot of them, and the recent regulatory framework actually specifies very clearly what we understand under the resolution mechanisms. So when the bank is in distress but it's not bankrupt yet, actually the banks have a set of the instruments which can be used to improve its financial health, and among them are such measures as transferring bad asset to the external company, which is called in the literature bad bank or asset management company. So already transferring already the bad portfolio improves banks' financial health and of course the capitalization of the institution. There is another measure called assisted merger. So this is a kind of the policy where the bank decides to sell the impaired asset to another bank, and through this kind of recapitalization, actually the bank's capital improves and the profitability of the institution improves. There are also some other measures which we tend to use when the banks cope with the liquidity problems rather than capital problems, as for example liquidity provisions which can be set by the central banks, when the central banks actually gives the banks the possibility to get the liquidity facility from the central bank. There are also government guarantees where the government tries to calm down the situation on the banking market, and it does not directly actually inject the capital into the banks, but it guarantees that the deposits, actually the depositors do not lose money. So this is the measures which are generally injected at the beginning of the crisis to calm down the situation on the banking market, and more specifically, not this kind of measure should help the stability of the banking sector, because then the liquidity problems, we can make sure that the liquidity problems do not transfer into the capital problems of banks. When we talk about the bailouts, actually, then the government directly injects the capital, the money into the banks. So it's already the situation when there are no other measures possible for policymakers, and this is why also the government steps in. And there are, of course, various motivations why the government decides to do it. The first reason, of course, is to calm down the situation, not to stop the possible contagion effects coming from the banks' distress into the other sectors, and of course into the recession. So this is one of the reasons. Another reason is, of course, banks' bankruptcies, especially big banks, would cost a lot of disruption in the global financial sector, including the bank runs, including the panic. So the cost of such crisis would have been much higher than the pure bailout. So this is actually the reason why governments decide to rescue the banks. And generally, they do through injection of capital by taking the bank's equity. However, recently there were also some other measures used, as for example, when the government decided to grant a loan to a bank, and through this way injects the capital into the bank. So there is a huge discussion on how the government should intervene and whether the government actually should intervene in the banking sector. And this is what our research is about.
So tell us more about your research. So what did you do and what did you find?
Yeah, so actually we look at the effectiveness of different resolution measures. So since 2014, the European directive abandoned actually the bank's bailouts, so abandon the taxpayers' money to be injected into the banking sector. The same has been done in the US. The Dodd-Frank Act does not allow to take the taxpayers' money to be injected in the banking sector. So actually, since financial crisis of 2008, where huge massive bailouts occurred in the global banking sectors, this have been massively criticized by the society and also by the regulators, because of a lot of problems which this kind of policies cause for the banking sector. And the policymakers decided to actually go away from the bailout policies, and they have specified what kind of measures can be used when the next financial crisis come. And these measures are especially transferring of bad asset into the external company, as well as assisted mergers. So when the banks can actually remove the license and sell the business to another bank, it might be with some help, but not financial help of the government or any other external institution. However, it cannot be done by taxpayers' money. So actually, what we were interested in our research was to look at how effective it will be in the next financial crisis, as well as we wanted to confront this kind of policy with the bailouts. We have to remember one thing, that improving banks' financial situation does not mean that the systemic risks or the contagion effects which come from different banks' distress will be stopped. So actually, what we look at the research, we wanted to look at two things. The first thing is how the situation of the banks will be improved when these measures, which have been explicitly specified in the European directive, will be effective during the next financial crisis, as well as we wanted to confront them against the bailouts. So what what is better? Is it indeed bailout? Can we indeed actually remove bailout, abandon bailouts? Will the banking sectors during the distress survive or not without the government money? And this is what we look at on a very big sample. We have collected the data on 39 different systemic banking crises, so global banking crises in both emerging countries as well as developed countries. And of course, especially we look at the financial crisis of 2008. So, and we confront actually different measures, because the bad banks, the mergers, these are not new measures actually. They have been used in a different ways in the recent financial crisis, generally with the government support, but some countries also offered us the experience without the government support, when this kind of measures have been implemented without the government support. So we actually had a quite big sample of different banks where this kind of measures were injected, and we of course had financial crisis 2008 where a lot of bailouts occurred. So we actually confront this kind of measures and look at the effectiveness of these measures. When the domestic crisis occurs, so actually when the banks just are in distress, and how these measures improve the bank situation. And on the other hand, we look also at the systemic risk. So will these measures be effective when there will be the global financial crisis? And there are a lot of interlinkages between the banks and a lot of interconnections between the banks, even between the countries. So we look at whether injection of one measure in one country, in one bank, will help to stop the contagion effects coming from the global crisis into other countries. So this was the second question we raised in our research.
And what did you find?
Unfortunately, the results are not very promising. So it means that the resolutions is a very complex mechanism, and it's not so easy just to take the resolution which has been specified in the directive and imply it, and then apply it, and then you have a kind of the medicine for the problems. We find actually that some of the measures are good in the beginning of the crisis. As for example, definitely we find that mergers, so in other words, the sale of bad asset into another bank, so when the other institutions help in restructuring the banking sector, is very effective in improving the stability in the banking sector, and specifically in financial sector. But we also find that it's only possible when the crisis is not very severe. So in other words, there is some liquidity and capital on the market, and actually the healthy banks can use it in order to make some transactions on the market. And the banks also do not have a very severe NPLs problems. So this kind of measures seems to be very effective in a way that it improves the health of the whole banking sector in terms of different indicators which we looked at. On the other hand, we find that bad banks are very effective only with the recapitalization of banks. So in other words, the pure bad banks, which have been mentioned in the directive, are not very effective, because if you don't have money, you cannot restructure actually the bad asset, right? So you need money in order to recapitalize the bank, and then be able to run the restructuring process at banks. But this kind of measures are effective only when we want to improve the situation of specific institutions, but they do not influence the systemic risk. So in other words, even though we improve the situation of the individual banks which are in distress, does not mean that the contagion effects coming from the global risk right, will diminish. In fact, we find that they might. This kind of measures might even lead to the further contagion effects. In other words, to the propagation of the systemic risk in the global banking sector. So this comes, of course, to the next discussion: should we abandon bailouts? And this is what our literature finds, that the bailouts are not very effective in improving banks' health, because actually the politicians do not have know-how, experience in running the restructuring of banks. So this is of course clear. But on the other hand, the guarantee which the government gives that depositors' money will not disappear from the banking sector stops the contagion effect, stops the systemic risk, and also the guarantees that the banks do not go bankrupt, of course, restores the confidence in the banking sector. And this is what our results say, actually, that even though bailouts are criticized very much because of different problems they cause for banking sector, however, that seems to be effective in resolving the systemic risk during the global banking crisis, whereas the resolution measures are effective when they are correctly applied, are effective in improving banks' financial health. But just, this is a kind of the idiosyncratic risk.
Right. So what do you think the Europe or the world in general, they are ready for the next financial crisis, taking into account your results of the paper?
Whether we are ready, the financial crisis which come next will have a totally different nature for sure. So we are entering, COVID-19 and the problems which we are facing to now are totally different that we used to have in 2008. Definitely the banking sector is much more capitalized, and we do have already some reforms, resolutions which can be applied when the crisis comes. So in other words, we can run the restructuring of the banking sector in an orderly and timely manner, because the reforms have been already implemented, right? So we know how to do it. In 2008, it was a little bit like in chaos. So we were trying to do everything, right? Just because at the beginning we even didn't know what is happening and how the crisis will evolve. So actually we're trying to use everything what was possible for policymakers. Right now we know how to react. Now we know what kind of measures can we use when the banking crisis comes. But the crisis will be different because the circumstances, the environment which is currently which we are currently facing to is totally different. So first of all, the profitability of banks is much lower than it used to be before 2008. Secondly, the governments have injected a lot of money already to face with COVID-19. So the fiscal situation of many countries is already quite weak, and moreover, what is even more important, that even though the bank's capital is quite in a good condition, but the situation in the corporate sector is very bad. At that time in 2008, we didn't have this kind of problems, right? So there will be definitely the crisis will be totally different, but the measures will be probably how to cope with the banking crisis probably will be the same. I don't think that we move away from the bailouts. I think that in severe crisis, systemic crisis, the bailouts will occur, because there is no other way, at least we don't know yet, the way how to stop the contagion effects coming from the systemic risk. And the measures which have been specified in the directives, they are, as I said, they are actually aimed at improving the bank's individual situation and then the whole system. So this is actually the drawback, and this is why these measures are also also criticize. So they are good when the crisis is local, but they will definitely not help when the crisis is gonna be systemic.
So there is still a scope for improvement, but there are some good things coming from the bailout measures and the resolution mechanism. So some things are still promising, and we can say that hopefully the next crisis will be dealt with better than the previous ones, right?
Definitely, yes.
Okay, thank you very much, Aneta, and thanks for being here with us and sharing your thoughts on the bailout measures and the financial crisis.
Thank you very much.